Hey, it's Triple Brain. Welcome back to everyone that has kept me in their subscription list and to those that have encouraged me to provide more content. And for everyone that's watching my videos for the first time, I'd like to warmly welcome you into my channel where I focus on due diligence, financial analysis, and technical discussions. Over the last week, I've gained a lot of positive and constructive feedback from the community, and it's really rewarding to have these engaging interactions with viewers that spend the time in their day to give me their input to help me improve. So thank you for all your time and suggestions. Your comments, ideas, and questions are heard on this channel. I will also include a segment at the end to address the questions that I have received from the previous video. Alright, let's jump right into the agenda of today's video. First is a review of Rocket Company's S1 and 10K financial statements. Second is an analysis behind the key metrics in the balance sheet. And lastly is a discussion of how these numbers might fluctuate with consideration to the variable interest rates and real estate conditions. I've included some chapter timestamps below for anyone that wants to jump on over to a specific segment of the video. But I encourage everyone to still tune in on some of the sections where you may already be knowledgeable on, so you can share your input and build meaningful discussions in the comments section below. And if you find this information helpful, please like and subscribe for more content. It goes a long way to help this channel grow so that more people can learn about the gems of the stock market. Now, if you're unfamiliar with the S1 filing, it's a financial registration form required by the SEC for new securities pending for an IPO. This is the document to the left. It highlights every crevice of a company, from its history, business model, consumer demographics, current products and services, partnerships, and above all, its balance sheet, which is the absolute most important element for any business. Similarly, the 10K filing is an SEC-mandated annual financial report provided by the company to the public that contains a review of the business structure, the risk factors, management inputs, and again, a balance sheet. This is the document to the right. Just think why Shark Tank investors are always so interested to ask about numbers like revenue, gross profit, margins, and volume of orders on the show, because no matter how well a product is made and how revolutionizing the technology may be, if it can't sell or it can't be marketed, it's worthless from a business perspective. Just like Van Gogh's artwork. It's just paint on a canvas if there's no one to appreciate it. Anyhow, I always recommend traders and investors to carefully read through a company's S1 and 10K filings during its pre-IPO to get a comprehensive look into the fundamentals, fiscal structure, and business model. Or at the very least, after the IPO, it's critical to understand a company's balance sheet, which varies hugely depending on the company. There are critical considerations when reviewing a balance sheet, such as the addressable market size, the average performance of leading competitors, the income to debt ratio, the margin of profit, total liabilities, growth projections and trends, and among many other things that I will discuss in today's video. So keep in mind a high revenue number, a high purchase frequency, a large consumer base, and a diversified business structure does not necessarily mean a company is in outstanding condition without further context. Variables need to be paired against each other and compared against competitors in the same market to validate its real performance. At any rate, here's the 10K balance sheet that details all the financial metrics for the full year of 2016 through 2020. Just for clarity, the 10K balance sheet had more up-to-date info on the full year 2020 financial results, where the S1 only provided up to March 31st, 2020. The first point of inspection that I use to assess a balance sheet is the average trend. This is the easiest element to identify because a balance sheet is laid out in an Excel format where you can easily look at the adjacent numbers to see whether the values of a certain metric is increasing or decreasing year by year. But while trends are a useful tool to determine if a company is growing or declining, it's very susceptible to misinterpretation. You see, trends are no different from coordinate points that don't have any reference points other than showing you the immediate differences between two or multiple years. As an example, if I started a business that had net losses from 2016 to 2018, the negative trend might be mistaken as a failing business. But in reality, I might have simply increased my expenses to build a solid foundation for my brand through marketing, designing higher quality products, investing into venture capital opportunities, hiring more staff, or relocating to a larger office space, all of which point towards a growing business. Or an alternative scenario is that I'm running an e-commerce website selling practical home goods. And from 2019 to 2021, I noticed that my revenue increased 200% compared to the previous year. This is a visible positive trend, but there isn't enough evidence to suggest that my business is growing bigger because I might not have done anything different from a business perspective. So this sharp increase could have been influenced by many confounding variables. So trends need to be compared against other variables in a balance sheet to justify whether growth or decline is really taking place. The other variable in this case are fundamental changes implemented in the business model or fiscal structure to create organic growth as opposed to relying on outside variables on a macroeconomic scale. Nonetheless, trends are still important despite its inherent drawbacks. Why? Because trends are used more than just a justification that growth is happening or not. It's a reinforcing element to support or deny the idea that the future of a business is headed towards the right direction. But again, trends must be complemented with other variables for it to be valid. In the case of rocket companies, the trend for total revenue undulates year by year. From 2016 to 2018, we see a reduction in revenue from $4.8 billion to $4.2 billion. But in 2019 and 2020, we see a sharp increase in revenue from $5.1 billion to an astounding $15.7 billion. This 300% year-over-year growth is a result of amplified mortgage originations from an excessively high demand in the housing market and a giant spike in refinances, of course, both of which stem from lower interest rates. To be clear, total revenue is generally a top-of-the-line variable, or in other words, the first few items on a balance sheet, because it provides insight into the total dollar amount generated through sales of products and services in a given year, without taking into account the expenses, of course. Total revenue, in other words, is a measure of all the money coming into a company each year. Of course, more money inflow is great, but we need to understand where this inflow is generated from. Is the inflow from increased sales? Is it from increasing the price of products and services? Was there some type of catalyst that increased demand? Were there any added revenue streams? There are among many questions that I would consider before looking at revenue at face value. Additionally, we want to know if the increase in revenue was due to higher expenditures, such as increased marketing, hiring more staff on board, improving product quality, expanding towards new products and services, better training, etc. So logically speaking, the more money you spend, the better the odds of greater returns. So that's why we should shift our focus towards the net income variable, which is derived from the total revenue minus the total expenses and costs of producing the products and services. In doing so, we can see if the company actually increased profit over time. Having said that, let's dig further into the expenditures at rocket companies. In 2020, Rocket spent $1.2 billion more in salaries and compensation compared to 2019. This represents a 55% increase for the category year over year. We also see a very gradual trend of increasing compensations from 2016 through 2020, which is generally regarded as a positive sign, as this usually points towards the intention to invest in human capital and bring more talent on board. This increase is consistent with Rocket Company's mission, as they are committed to the enlargement of their footprint in the financial technology sector, and such conversions are often meticulous, technologically challenging, and costly in terms of developing the human capital to fill in the new roles that require an extensive background in technology. This simply means that Rocket Companies is spending more on paying their employees in order to build a team of competent and reliable engineers, developers, management, and product specialists. This is similar to what many startup companies are doing by offering higher compensations to attract well-qualified candidates to join the team. Likewise, we see that general and administrative costs are increasing steadily from 2016 to 2020. This is a broad category of spending that includes rent, utilities, legal fees, insurance, and day-to-day expenses. For the most part, these expenses remain relatively stable year over year for most non-startup companies, as many of these expenses are fixed and have matured over time. But large fluctuations may occur primarily due to some major structural, operational, or managerial changes. Perhaps Rocket Company's push into fintech is accruing greater day-to-day expenses, especially on technologies that increase efficiency that we will discuss later. To support the notion that Rocket Companies is investing in human capital, the 10K does in fact report that their talent management team actively supports their employees to broaden their scope of expertise by providing mentorship, training, and leadership programs. They have a Thrive program, which coordinates vertical transition opportunities to higher roles within the company and promotes lateral transitions to help employees acquire new skill sets within the ecosystem that they have created. On their website, Thrive helps with job matching, interviewing, and shadowing. In 2020 alone, 2,000 members of their staff were transitioned, and this likely contributed to the increased salaries. Likewise, the Rocket Company's career page has an extensive list of user experience and user interface engineers and management positions, as well as engineering roles with an emphasis on AI technology, search engine optimization, software development, data management, among others, all of which demand higher compensation packages and benefits. It's clear that they are on a mission to fully establish a presence in the fintech space, and they are not afraid to spend some extra money to make it happen. Rocket is really defining the notion of putting capital to work by cultivating talent within its organization, and I think this ultimately contributes to satisfaction and quality in their team of 24,000 people. Assessing further down the list of expenses, in 2020, Rocket appropriated $950 million in marketing, which represents a 5% increase between 2019 and 2020. If there's any critique here, it might have been smart for Rocket to focus on diversifying their marketing streams into other social platforms and entertainment channels to further take advantage of the thriving mortgage sector. I think most of what Rocket has done in terms of their marketing strategy is leveraging the sports team that Dan Gilbert owns, as well as paying for a spot in the Super Bowl commercials. But I think there are more effective ways to promote their products and services, which would be through radio, which reaches far more adults in the United States than any other medium. I think this number is in the ballpark of 85% to 90% of adults in the US. Another option could be sponsoring a couple of big YouTubers in the finance category, which would be relatively inexpensive for the reach that they can offer. It's all about visibility, and I think for most people that gets a quick glance of this company for the first time, they would be more interested to look further in seeing how diversified their lending options are. There is, however, something that's worth noting, which is that despite a plateauing of marketing expenses in the last 4 years, Rocket companies managed to increase their clientship categorically across their core products and services year over year. This is always a good sign, and usually this occurs when clients are referring their families or friends to their platforms, and this can also mean that Rocket is doing a good job at introducing the brand to new customers in the market. But the smart spending doesn't end there. I dug a little deeper into Rocket's spending categories and found that in 2020 alone, they released 4,500 brand new products in the fintech, real estate, and lending automation areas. This includes financial tools to enhance processing speeds and autonomy in lending, real-time communication services, and a list of efficiency programs to handle digital applications. These products were collectively integrated into its core products as well as their subsidiary companies. A noteworthy mention among this list of new products is the Rocket Pro Insight, or RPI, which is a digital platform that facilitates communication between agents and borrowers and allows real-time updates on the mortgage origination status. RPI accelerates the mortgage transaction and home buying process because it gives real estate agents immediate access to status updates and eliminates much of the delay involved in non-electronic methods of loan processing. Another great product on this list of added technologies is Rocket Logic, which is an in-house created workflow optimizer, which processes transactions, documents, client data, and loan origination data at a 20% increased efficiency. This is essentially a software that increases the overall processing speed primarily across its core products and services. In this day and age, speed and efficiency is important for both businesses and customers because it saves time, resource allocation, and completes a business transaction at a quicker rate. For customers applying for a mortgage, improving the handling time is extremely important because pre-qualifications, offers, and closing on a home purchase are all time-sensitive issues that are especially amplified with this high market demand. Another product worth noting is the release of Clear HOI through its Nexus subsidiary company. Clear HOI is a powerful suite of digital programs that assists with the communication between mortgage lenders and homeowners insurance companies. If you're noticing, Rocket is developing and incorporating a network of communication channels between all the parties involved in the lending and home buying process, which systematically improves the workflow and handling times to outdo their competitors in every aspect. Clear HOI has improved the speed of equipping new homeowners with insurance from a matter of weeks to only minutes online. In its annual reports, Rocket companies also reported spendings in the development of AI technology and robotic process automation. I suspect that these large investments in AI technology, automation software, and workflow optimizers are more than just pieces to the fintech architecture that they are building, because they've already established an efficient ecosystem of companies that categorically outpace their leading competitors. Instead, I think Rocket is actually investing into these technologies to handle the volume of transactions that are coming through on their multiple channels of products and services. Currently, the AI and automation technologies combined with the previously mentioned technologies are capable of handling 3 times the current volume, which I think they are anticipating to service in the coming years. Now that we've covered some of the big ticket items in the expense section of the balance sheet, the more important question to address is how cost-effective Rocket's business model is. We can do this by dividing the total expenses by the total revenue to determine the operating expense ratio. This number provides insight into how much risk Rocket Companies is willing to take to generate revenue. We usually look at this as a percentage to help contextualize the numbers. The operating expense ratio can also be interpreted as the risk to reward ratio, which of course, the lower the percentage, the lower the risk involved. Now, if we find the ratio for each year between 2016 and 2020, we can visualize whether Rocket Companies is actually improving its risk management and profitability by tracking it on a graph. But remember, a decreasing percentage value over time indicates improvement, so a negative slope would be a good sign. To simplify the concept of an operating expense ratio, I'll provide a hypothetical scenario. If I spend $10 to make a pizza and then sell this pizza for $20, my expense ratio is $10 cost to $20 revenue, or a 50% expense ratio. Likewise, if I spend $5 to make the pizza and sell it for $15, my expense ratio would be 33%. In both scenarios, I profited $10, but the expense ratio in the second scenario is lower and more ideal. This is because I only risked $5 to make the $10 as opposed to spending $10 to make the $10 like the first scenario. For additional context, a medium to large business that can achieve an expense ratio of 60 to 70% is likely doing a fantastic job of risk management, leveraging their capital, marketing, and regulating their fiscal structure. Remember, selling a product or service is very different from you selling a pair of shoes that you can flip for 3 or 4 times the price that you paid. Companies of this magnitude must invest in research and development, staff, utilities, production costs, facility space, and a long list of expenses before getting a product to the market. At this point, their expenses are high and their profit margins are slim. To compensate, companies must use their capital, cash flow, and available loans to leverage and scale the business to sell their products in vast quantities. Or simply put, they compensate for the small profit per unit of sale by increasing the volume of sales. That is why even at a 70% expense ratio, this would put a medium to large business at a very elite level. I also want to bring your attention to some of the more recent developments in the competitive lending market. Back in March, mortgage lending giant United Wholesale Mortgage, or UWM, initiated business warfare against Rocket Companies by threatening to end ties with all independent brokerages that partner with Rocket. Keep in mind that prior to this, independent brokerages were freely able to operate business between both parties, and both Rocket and UWM were major suppliers of mortgage orders. However, UWM's decision forced independent brokerages to choose a side, and logic of course favors the more profitable and active supplier of mortgage originations. In the aftermath of the situation, Rocket Mortgage reported that 22 of their 25 largest partners have decided to reject UWM. Moreover, Rocket's wholesale mortgage division, branded as Rocket Pro TPO, reported an astronomical $97 billion in lending volume in 2020. But here's where the confusion happens. UWM managed $182 billion in lending volume in the same year, which is twice that of Rocket Pro TPO. So why would they even bother to stir conflict when they still remain as the nation's largest wholesale mortgage originator? The answer lies in the projections and market share. You see, UWM CEO Matt Ishbia is a clever guy. He understands the rising competition in the wholesale mortgage industry where Rocket Pro TPO is starting to gain significant grip in the market. By the way, the wholesale lending business is separate from the retail lending business, both of which Rocket taps into. Wholesale loans are sold to government-sponsored entities like Freddie Mac and Fannie Mae, as well as banks, credit unions, and other financial institutions. Retail lending, on the other hand, is where Rocket directly provides the liquidity to borrowers and regulates the entire process from end to end. In my previous video, I go into detail about the business model if you're interested. But back to my original thought. Rocket Pro TPO is growing at an alarming rate, more than doubling its revenue from 2019 to 2020. This is proportionately faster than UWM, which is still doing fantastic in their own right, but subpar to Rocket's brand. I believe that this is a central motivation for the ultimatum, and it seems that this move has backfired for UWM. On the same note, the revenue generated from Rocket Pro TPO is listed in the balance sheet under the category of partner network origination volume, which if you look at the trend from 2018 to 2020, the business has grown somewhere in the ballpark of 600%. They are essentially vacuuming market share at this point. Again, this growth is all driven by technological innovation, brand recognition, effective marketing, streamlining the products and services, extending reach through diversified brands and partnerships, and of course, high customer satisfaction. Moving on, I've got a few essential metrics that are commonly used to assess the health and relative strength of a company's fiscal core. Net income sits at $9.4 billion in 2020, a mind-boggling 1,050% year-over-year increase from 2019, and a 1,500% appreciation from 2018. Remember, net income refers to the total revenue minus expenses, tax liabilities, and interest accrued. A positive net income in itself is an indicator of financial wellness, as this is the take-home pay of the business. For rocket companies, a positive net income is quintessential due to its large infrastructure and diversified products and services, which requires large cash reserves to maintain during rainy days. There are many alternative uses to this excess capital, such as scaling the core products, acquisitions, venture capital, dividend reimbursements, adding to the cash flow, storing liquidity to support retail mortgage businesses, forbearance protection, hiring and training new staff, or simply paying off debt and liabilities to reduce burden. And it's also important to note that since 2016, Rocket's cash flow has been positive and growing quickly from $800 million in 2016 to $2 billion in 2020. Adjusted EBITDA is also another golden standard for assessing and comparing a company's performance against the industry, because this is the company's income before interest deductions, taxes, stock compensations, among others. In some cases, companies might have a different accounting or financing structure, or might just award large sums in stock compensations, which might create unsettling numbers in the net income section. For rocket companies, EBITDA grew by 572% between 2019 and 2020, which is a true growth of the company's profits. The future certainly looks bright for rocket companies, but positive net income still needs to be observed against its net profit margins for additional context. This is to say, what percentage of the revenue is being converted into profits. For many businesses, profitability can be hindered by high interest on debt, wasted human capital, excessive overhead costs, and failing investments. This is why companies that achieve even a 20% profit margins are considered to be in an outstanding position. For 2020, Rocket's net profit margin is 60%, a growth of 43 percentage points from 2019. Here, I also have a list of displaying the average net profit margins for various industries, and even the most resilient financial and real estate sectors only sports above a 20% and 29% respective average. As a side note, the high profit margins is also why Rocket is able to operate the business each year without tapping into its cash flow, and instead adding to it. The profits are high enough to be reinvested, and the remainder is stored into its cash flow nest. Now, the obvious argument is that Rocket had a monster year, an outlier at best, but I tend to disagree with this narrative simply because if we eliminate every financial metric that could be influenced by an overzealous mortgage frenzy and lowered interest rates, there is no denying that the fundamentals remain intact. Again, technological developments, diversification, automation via AI, and an incredibly equipped staff all point towards a bright future for Rocket. Also, don't forget that rocket companies occupy the largest share of the highly fragmented mortgage market. There are over 11,000 financial institutions in this pool, and Rocket Companies is primed to capture an even larger portion of the pie. So the prospect of stabilizing these monumental numbers in the future is more likely than not. It's also important to note that capturing market share tends to have a snowball effect, where major players cannibalize smaller players due to competitive and capital advantage. On top of this, Rocket's subsidiary businesses will also likely synchronize in growth of market share in their own markets, which would further bolster high revenues in the coming years. I've distilled a few performance indicators here in this table to show that Rocket Mortgages and its subsidiary businesses have been moving in a positive direction in terms of revenue from 2018 to 2020. And this newly developed fintech product and upgrades that will be systematically integrated across all platforms will likely see increases on all fronts. But the underlying message here is not just to reaffirm the idea that the brand is doing well, but that all of the Rocket entities are still in the growth phase and that Rocket doesn't only rely on a single flagship product to bring in revenue. In many cases, we see failed diversification attempts in businesses that try to streamline products and services because ancillary products are often overshadowed by flagship products. But in the case of Rocket, Rocket has managed to do something very unique, which is successfully growing the tail ends of its businesses as well. Up to this point, I've been pretty optimistic about every metric on the balance sheet, but I'm not a car salesman for this stock and I'm not here to promote any confirmation bias. That being said, I'll be addressing a few concerns regarding the outlook of this company and provide realistic projections of what I anticipate in the near future. As you know by now, Rocket Companies accounts for a substantial portion of the net annual revenues through the sale of wholesale mortgages to GSEs and retaining servicing rights for additional income. They've also created an effective revenue stream by offloading a chunk of the origination volume to partnering brokerages, which unwinds the queue of mortgage origination requests and allows for higher origination volumes. But remember, the mortgage and refinance industries are governed by the performance of multiple variables, such as the real estate market conditions, interest rates, demographics, and even investment psychology of home buyers and sellers. Simply put, Rocket Companies is riding on a high tide at this moment where all the conditions directly prop up the volume and frequency of mortgage originations. But let's talk about the real estate market for a moment, because it's the hot topic nowadays and it's directly related to Rocket Mortgage's success. Say, if you're in the market for a home today, you might notice an extremely low supply of homes available compared to just 2 to 3 years ago. The options are less vibrant, the prices are sky high, and the bidding process is no different from a war zone. A home listed for $650,000 in California might have 15 to 20 bids that are 10 to 15% above the asking price, and sometimes as an all-cash offer. What you're observing is a bottlenecking of home buying, which is when most of the homes available in the market are swept up in a short time frame, leaving very little time for a fresh supply of sellers to replenish the market. This creates an initial contraction in interest and demand for homes, followed by bidding wars and over-leveraged mortgage borrowing, and ultimately increasing the incidence of forbearances down the line. Evidently, this buying frenzy is stimulated by the lowered interest rates, remote working opportunities, high cost of rent, and fear of missing out. And Rocket Mortgage sees this opportunity perfectly to deliver the mortgage liquidity to prospective home buyers, which resulted in the outlandish numbers for the full year of 2020. Logically, this makes us question the sustainability of these revenue figures, and this is the obvious and the foremost concern. You see, as with all market trends fueled by a sudden influx of demand for a commodity that lacks supply, the appetite for home buying will inevitably decelerate. At first, this might seem contrary to the law of supply and demand, where demand is high when supply is low. But remember, the principle of supply and demand is largely based on the idea that supply is finite and limited to a specific time frame and cost. An example would be Tesla's initial release in China, which spurred a retail frenzy that cleared most of the supply of the Model 3s and Model Ys in a short time frame. Shortly after this wave of buying, Tesla's production inefficiencies, along with increased regulation, slowed the rate of supply, and the appetite of buying visibly dropped even throughout the holiday quarters. The same thing goes for the real estate market. If the supply of homes is not finite and slow to be replenished on the market, it loses a lot of traction, especially when home buyers are making decisions to take on 30-year mortgages and strapping hundreds of thousands of dollars into a property. Giving them time to reevaluate their decision will ultimately stunt the volume of home purchases. People do end up changing their minds. On top of this, I think a large portion of individuals and families that can actually afford to pay top dollar for a home have already made their purchases, leaving a much smaller demographic of people that are either still deciding to buy or simply unable to afford a home at this point. Based on the most recent collected data, the median home value in the US for 2020 has risen 17% to $341,000, or just 4.5 times the median annual household income. An astounding 43% of homes sold in 2020 were above the asking price, and 49% of sellers accepted an offer within 2 weeks of listing, meaning the homes barely matured in the market before being purchased. In fact, monthly data suggests that homes are now just sitting in the market for an average of 23 days before being sold, compared to 38 days in 2020 and 43 days in 2019. In more popular markets such as California, Colorado, Utah, and Texas, 65% to 71% of homes were sold an average of 6 to 7% above the asking price. So despite having lowered interest rates, the sheer overvaluation of homes effectively negates much of the lower interest rate benefits. And on top of this, property taxes on the above the ask premiums added additional costs to home buyers in the long run. Moreover, per Rocket Mortgage's collected statistics, 33% of home buyers in 2020 were first-time buyers that likely have no intention to resell their homes or make another additional purchase in the short term. And the remaining 67% of home buyers have already exchanged hands at least once before, making them less inclined to make any additional purchases. Especially for families relocating to faraway areas and those with children, they are very unlikely to be going through another mortgage process in the short term. The above is a collection of statistics on Rocket's website to provide a bit more visibility into the current market conditions. Based on these conditions, what you get in this situation is a real estate market that will likely cool off. I expect the demand for homes to readjust to healthy levels and the supply to gradually replenish, creating lower mortgage origination frequencies and volumes, but in the long run, creating a less volatile and more stable growth for the mortgage market. What does this mean for Rocket companies? Well, if my research is correct here, I think the Rocket mortgage business might suffer from lower origination volumes throughout this year and the next, at least while the market cool-off is still taking place. However, their increased market share will likely offset some of the mortgage origination declines by filling the gap with new customers. On a final note, interest rate is a huge underlying factor for the success of Rocket's 2020 annual reports. According to the S1 and 10K filings, interest rates are a significant contributor to mortgage origination volumes for both their wholesale and retail lending business. Low interest rates promote higher frequencies of borrowing because people are able to pay less on interest debt in the long run. As an example, Rocket reports that the average mortgage size for their customer is $278,000 in 2020. On a 30-year fixed-rate mortgage, a 1% reduction in the interest rate, as seen from 2019 to 2020, is roughly a $120 to $130 difference per month. Interest rates, therefore, are extremely costly in the long run, and of course, lower interest rates means that people have less weight on their shoulders to afford a home. However, it is anticipated that the interest rates will gradually rise in the next 2 to 3 years, which appears to be a counterproductive change for Rocket companies. But Rocket CEO Jay Farner suggested that fluctuating interest rates will not have any significant impairments to the revenue. He did not comment further on this claim, but I think the idea behind this is firstly their diversified multi-stream of revenue that can offset declines in one portion of their business, and the other being the market share gains that I mentioned earlier. As they draw in more customers and from competitors and retain generational business from millennials, they will be able to dampen the effects of higher interest rates. Moreover, in the time leading up to the proposed interest rates, I think this might be a catalyst that creates a second wave of home buying once the market is replenished because people may be looking to purchase homes before the hike. But it's very difficult to say exactly how interest rates will play a role in the real estate market in the future because we are at a peak in buying and the data reflects overbuying and over-leveraged buying as indicated by the rise in forbearances and foreclosures. Here is a great question that was brought up by a viewer that was concerned about the Tax Receivable Agreement, or TRA, that Rocket Companies has agreed with founder Dan Gilbert. TRAs are extremely complex pre-IPO arrangements that usually are hidden in the balance sheet under the liabilities or debt repayments category. TRAs are considered to be very beneficial to founders or early adopters because it provides significant tax advantages and reimbursements to these parties. They are basically a form of long-term compensation that gets taken from free cash flow if the founder or early adopters decide to sell their position. At face value, they are definitely unfavorable for a company because taking money from free cash flow to pay founders is not in the best interest of any investors. But I just want to make it clear that this is very, very common in the corporate world of pre-IPOs, and there are many forms of TRAs. For Rocket companies, they have a basis TRA or an Up-C structure, which is intended only to mitigate the tax responsibilities should shares of the companies be sold by Dan. But the thing is, Dan really has no incentive to sell despite selling 20 million shares for charity purposes, because he knows this company is just beginning to fill in the fintech space, and the potential is huge. I'd imagine that should Dan really sell, Rocket would have appreciated significantly already, and the TRA liability due by Rocket companies to Dan would be offset for the public investor. And with that, this is the end of the video. I hope you enjoyed the content and feel free to ask any questions as they will be featured on my next video. If you found this content helpful, please leave a like and subscribe for more videos. See you on the next one, guys.